Hello, and welcome to the Alpha Bureau. Today, we're diving into a truly seismic shift in the U.S. sports betting industry. On October 22, 2025, the NHL announced a multi-year partnership with two prediction market platforms, Kalshi and Polymarket. This isn't just another sponsorship deal. It's the first time a major U.S. sports league has officially embraced prediction markets, and the implications are profound. Wall Street thinks these new platforms are simply additive to the existing market, but we believe this view is fundamentally wrong. Today, we'll show you why this partnership exposes a critical blind spot in the wagering industry and how it threatens the duopoly that DraftKings and FanDuel have built. Let's get started, and don't forget to subscribe and hit that like button. October 22, 2025. That's the date that marked a turning point in the U.S. betting landscape. The NHL's announcement wasn't just about adding new sponsors. It was about legitimizing an entirely different way of wagering, one that operates under a fundamentally different regulatory framework. This partnership sent shockwaves through the industry because it signals that prediction markets, which have been operating in a legal gray area, are now being accepted by mainstream sports organizations. This is the beginning of a new competitive era, and the existing giants are already feeling the heat. So what exactly did the NHL give Kalshi and Polymarket? First, official data rights. Both platforms now have access to NHL's proprietary data, which means their markets will be backed by accurate, official statistics. Second, trademark and logo rights. They can now use the NHL's marks and logos on their platforms and marketing materials, which gives them enormous brand credibility. And third, brand exposure during national broadcasts, including regular season games, the Stanley Cup playoffs, and events like the Winter Classic. This isn't just a licensing deal. The NHL is essentially endorsing these platforms as legitimate fan engagement tools. That's a huge stamp of approval. Now, why would the NHL do this? The answer lies in strategic calculation. The NHL is often considered the fourth league among major U.S. sports, behind the NFL, NBA, and MLB. They need to innovate to compete for fan attention. By partnering with prediction markets first, they're positioning themselves as a first mover, embracing the future of fan engagement before their larger competitors. Second, prediction markets attract a different demographic. These platforms appeal to data-savvy, finance-oriented fans who might not be traditional sports bettors. The NHL sees this as a way to tap into a new highly engaged audience. It's a calculated risk, but one that could pay off significantly. To understand why this is such a big deal, we need to look at the current market structure. The U.S. online sports betting market is dominated by two companies. FanDuel, owned by Flutter Entertainment, holds about 43% market share. DraftKings comes in second with around 35%. Together, these two control roughly 78% of the entire market. BetMGM has about 8%, Caesars around 5%, and ESPN bet just 3%. This is a classic duopoly. The two leaders have massive scale, brand recognition, and customer acquisition flywheels, meaning they've created a positive feedback loop where more users lead to a better product and more betting options, which in turn attracts even more users. This makes it extremely difficult for anyone else to compete, or at least that's been the conventional wisdom. And this isn't a small market. The U.S. sports betting market was valued at $9.6 billion in 2024. According to Mark Group, it's projected to reach $27.4 billion by 2033, growing at a compound annual growth rate, or CAGR, of 11.1%, meaning it's expected to grow by an average of 11.1% each year for the next decade. This is a massive opportunity, and it's the territory that DraftKings and FanDuel have been defending fiercely. But as we'll see, this growth isn't guaranteed to flow to the incumbents. Many have tried to challenge the duopoly, and most have struggled. Take Penn Entertainment, for example. They initially partnered with Barstool Sports, investing heavily, but that failed spectacularly, and they sold it for just $1. Then they signed a massive 10-year $2 billion deal with ESPN and ESPN Net. The goal was to capture 20% market share by 2027, but they're currently stuck at around 3%. Caesars Entertainment and MGM Resorts, both traditional casino giants, have also tried to expand into digital sports betting. Caesars has about 5% share, MGM around 8%. Despite their extensive physical assets and loyalty programs, they're struggling to compete online against the digital native leaders. Given this landscape, Wall Street's consensus has been clear. Analysts believe that DraftKings and Flutter have won the war. Their scale, brand power, and customer acquisition flywheels, those self-reinforcing growth engines, are seen as insurmountable advantages. The common view is that the duopoly is secure, and there's no room for new entrants to disrupt the market. But this consensus is about to be challenged in a way that most investors don't yet understand. Enter the prediction markets. Polymarket was founded in 2020 by Shane Copeland. It's a decentralized prediction market built on the Polygon blockchain, which acts like a fast and low-cost highway for transactions. It uses the USD stablecoin, which is essentially a digital dollar pegged one-to-one with the US dollar. Users can trade on the outcome of real-world events, from politics to sports, by buying and selling outcome shares, which are like stocks that pay out if a specific event happens. What makes Polymarket unique is its zero trading fees. The platform doesn't charge users to trade. Instead, Instead, it generates revenue through other means like liquidity provider incentives, basically rewards for people who help facilitate trades, and venture capital funding. This low-cost model attracted a crypto-savvy user base initially, but it has since expanded far beyond that niche. Kalshi took a different path. Founded by Tarek Mansour and his team, Kalshi became the first CFTC-designated contract market for prediction markets in the US. This means they operate under federal regulation by the Commodity Futures Trading Commission. Users trade event contracts, which are financial instruments that settle based on yes or no questions. Like, will the Fed raise rates at the next meeting? This regulatory approach gave Kalshi legitimacy, transparency, and crucially, federal oversight instead of state-by-state licensing. Here's where things get really interesting. Traditional sportsbooks like DraftKings and FanDuel operate as the house. They set the odds, and their profit comes from the hold or vig built into those odds. The bettors, as a whole, are expected to lose over time, and that's how the house makes money. Prediction markets, on the other hand, work like exchanges. They're peer-to-peer platforms where users trade directly with each other. The platform itself just facilitates the trades and earns a small commission. This is fundamentally more efficient and structurally offers better value to users. We've seen this movie before. In the UK, a company called Betfair revolutionized the betting industry by introducing the exchange model in 2000. Before Betfair, UK bettors faced odds that were structurally unfavorable due to bookmaker margins. Betfair's exchange eliminated that margin, and users could get odds that were, on average, 20% better. That's not a marginal improvement, that's a structural advantage. Betfair proved that the exchange model offers fundamentally superior value to consumers. And now Polymarket and Kalshi are bringing that same model to the US. Polymarket's breakthrough into the mainstream came with the 2024 U.S. presidential election. Over $3.3 billion was traded on markets predicting the outcome between Trump and Harris. Polymarket's predictions were widely seen as more accurate than traditional polls. Events like the Titan submersible disaster also drew massive attention, with markets aggregating real-time information to produce probability estimates. Prediction markets had evolved from a crypto niche into a mainstream tool for forecasting, recognized by political analysts, financial institutions, and the general public. And now, they're moving into sports. The mega's reaction to the NHL partnership was immediate and powerful. Within hours of the announcement, Kalshi's Stanley Cup 2026 futures contract saw over $980,000 in trading volume. On Polymarket, a single regular season game between Montreal and Calgary generated more than $683,000 in volume. These numbers prove that there's real, substantial demand for officially sanctioned sports prediction markets. This isn't a fringe experiment anymore. It's a viable, rapidly growing market. Not everyone was thrilled. The American Gaming Association, which represents traditional casinos and sportsbooks, issued a scathing response. AGA CEO Bill Miller called the partnership deeply troubling and labeled prediction markets as backdoor gambling schemes disguised as financial products. He accused them of circumventing state regulations, taxes, and consumer protections. This fierce backlash reveals just how threatened the incumbents feel. They see prediction markets as an existential threat, and they are fighting back hard. But here's where Wall Street gets it wrong. The consensus view, led by firms like Susquehanna Financial Group, is that prediction markets are additive to the existing sports betting market. The argument is that these new platforms aren't cannibalizing DraftKings and FanDuel. Instead, they're expanding the overall pie by attracting new users who wouldn't otherwise bet. This view has been widely accepted by investors, and it's one reason why DraftKings and Flutter's stock prices haven't collapsed. But we believe this analysis is fundamentally flawed. Let's look at the data that supports the additive narrative. In September 2025, Kalshi's sports-related trading volume, when converted to a comparable handle, which means the total amount of money wagered, like traditional sportsbooks use, was approximately $1.25 billion. The total regulated U.S. sports betting handle that month was about $15 billion, so Kalshi represented only about 8% of the market. Analysts argue that this is a small enough share that it's not a real threat, but this static snapshot misses the dynamic forces at play. The second argument for the additive view is geographic. Most of Kalshi's volume comes from states where sports betting is illegal yet. California and Texas, for example, have huge populations but no legal sportsbooks. DraftKings and FanDuel can't operate there, but prediction markets, regulated at the federal level, can. So the theory is that prediction markets and traditional sportsbooks are serving different geographic markets, and therefore they're not directly competing. Again, this misses the point. The market's blind spot is this: they're treating this as a customer competition, but it's actually a jurisdictional war. The real battle isn't about who can acquire more users in the short term, it's about which regulatory framework will dominate in the long term, and that's a structural question that will reshape the entire industry. Here's the core conflict. Traditional sportsbooks like DraftKings and FanDuel are regulated state by state under gambling laws. They need a license in each state where they operate. They're subject to state gaming boards, state taxes, and state consumer protection laws. This patchwork system is expensive, complex, and limits their ability to scale nationwide. Prediction markets like Kalshi, on the other hand, are regulated federally by the CFTC. They claim their event contracts are financial derivatives, not gambling, which means they fall under federal, not state, jurisdiction. If that claim holds up in court, they can operate nationwide under a single regulatory regime. This is what we call regulatory arbitrage, and it's an enormously powerful competitive weapon. This isn't a theoretical debate, it's being fought in courtrooms right now. Multiple state regulators, including New York, Ohio, Nevada, New Jersey, and Maryland, have issued cease and desist orders against prediction markets. They argue that these platforms are gambling operations that must comply with state law. Kalshi has fought back, filing federal lawsuits claiming that the CFTC has exclusive jurisdiction and that state laws are preempted. The results have been mixed. Federal courts in Nevada and New Jersey sided with Kalshi and issued injunctions blocking state enforcement, but Maryland's court ruled against Kalshi. This split creates legal uncertainty. Because lower courts are split, this issue is almost certainly headed to the Supreme Court, likely by 2027 or later. Until then, the legal ambiguity acts as a strategic moat for prediction markets. They can continue to build their user base, establish network effects, meaning the platform becomes more valuable as more people use it, and capture market share in states that are legally closed to traditional sportsbooks. By the time the courts resolve this, prediction markets may already be too big to ignore or shut down. That's the bet they're making, and it's working so far. And they have powerful political tailwinds behind them. Donald Trump Jr. is an advisor to both Kalshi and Polymarket, signaling strong ties to the administration. More importantly, President Trump nominated Michael Selig to chair the CFTC. Selig has publicly stated that banning sports event contracts is arbitrary and capricious, and he's expressed support for allowing prediction markets to expand into sports. This political backing strengthens prediction markets' position and makes it harder for state regulators to shut them down. So how are the incumbents responding? DraftKings made a major strategic move in October 2025 by acquiring Railbird Technologies, a CFTC-licensed exchange, reportedly for $250 million. They also announced plans to launch DraftKings Predictions, a new prediction market app, with an initial investment of around $50 million. This is a clear defensive pivot. If prediction markets are going to be a threat, DraftKings wants to be in that game too. But this move also reveals their fear. Look at how the market reacted. In the 30 days leading up to the Railbird acquisition announcement, DraftKings stock price fell about 25%, with investors citing concerns about prediction market competition. But when the acquisition was announced, the stock surged 6% in after-hours trading. This tells you that the market was deeply worried about the threat, and the acquisition was seen as a necessary response. The threat is real, and investors know it. FanDuel isn't sitting still either. Flutter Entertainment partnered with CME Group, the world's largest derivatives exchange, to launch their own event contract products. This is another defensive move. Both leaders are now scrambling to enter a market that they previously dismissed. When the two most dominant players in an industry both pivot to adopt a new model they once criticized, that's a clear signal that the disruptive force is real. But here's the dilemma. DraftKings and FanDuel's core revenue comes from their bookmaker hold, the margin built into the odds. Their business model depends on customers losing money over time. Prediction markets, on the other hand, are peer-to-peer exchanges with much lower margins. By launching their own prediction market platforms, DraftKings and FanDuel are essentially legitimizing a model that undercuts their own high-margin business. They risk cannibalizing their core sportsbook revenue with their own lower-margin exchange products. It's a classic innovator's dilemma. Do they protect their current profits, or do they adapt to the future market structure at the expense of those profits? They're stacked. So let's talk about the structural losers in this scenario. We believe DraftKings and Flutter are facing long-term margin compression that the market hasn't fully priced in. Their current valuations are based on high-margin products like same-game parlays. But as prediction markets with lower costs and better odds for users enter the sports betting space, price competition will intensify. Even if DraftKings and FanDuel launch their own exchanges, they'll be competing against themselves. Consumers will rationally choose the platform that offers the best odds. The result will be downward pressure on margins across the industry. The high profitability that's baked into their stock prices today is unlikely to be sustainable. That's the structural headwind they face. So, who are the structural winners? In a gold rush, the most reliable profits don't go to the miners. They go to the people selling picks and shovels. In the wagering ecosystem, the same principle applies. The smartest investments are in the companies that provide essential infrastructure to all platforms, regardless of who wins the consumer-facing battle. Let's look at the numbers. Sportradar has a market cap of $7.67 billion, revenue growth of 26%, and an operating margin of 12%. Genius Sports has a market cap of $2.77 billion, revenue growth of 24%, but is currently unprofitable with a negative 11% operating margin as they invest in growth. Nuvei, also known as Corpay, has a market cap of $19 billion, revenue growth of 6%, but a very strong operating margin of 44%. These are the enablers of the ecosystem, and they're positioned to win regardless of the platform wars. Data providers like Sportradar and Genius Sports are the tollkeepers of the modern wagering industry. They hold exclusive data deals with major sports leagues like the NFL, NBA, MLB, and NHL. Any platform, whether it's DraftKings, Polymarket, or Calvi, must pay these companies for access to official league data. That's a toll they can't avoid. As the NHL partnership explicitly states, Calvi and Polymarket get access to NHL's proprietary data, which almost certainly flows through Sportradar or Genius Sports. The more the industry grows and digitizes, the more valuable these data monopolies become. They're the infrastructure layer, and infrastructure always wins. The same logic applies to payment processors. Online gambling is classified as a high-risk industry, requiring specialized expertise in compliance, fraud prevention, and regulatory navigation. Companies like PaySafe, which owns Skrill and Neteller and Nuvei, have deep experience in this niche. As wagering volume increases and new platforms proliferate, these processors benefit from every transaction. They don't care who the customer is betting with. They just process the money and take a cut. Their revenue scales with industry volume, making them another class of structural winners. Let's summarize what we've covered today. The NHL's partnership with Polymarket and Calvi isn't an incremental development, it's a paradigm shift. The core competitive weapon here isn't better marketing or a slicker app, it's regulatory arbitrage. The battle between state and federal jurisdiction. Incumbent sportsbooks face structural margin compression as the exchange model, which offers better odds to consumers, gains traction. And the smartest investment strategy isn't to bet on which consumer platform will win. It's to invest in the ecosystem enablers, the data providers, and payment processors that profit no matter who wins the platform wars. If you found this valuable, please subscribe to the channel and give us a thumbs up. Thanks for watching the Alpha Bureau, and we'll see you in the next one.